Now, this stock was a disaster, and I had this stock in my portfolio. However, I had a very narrow escape in this stock. So, let me explain to you the whole story. As I had said before, every trade is like a story, okay? And I love narrating the story. So, let us discuss why did I buy the stock? Where did I buy the stock? Where did I exit the stock? And was my decision correct? Was my decision to buy the stock correct? And was my decision to sell the stock correct? Let us discuss this. In hindsight, we can come to know what we did right, what we did wrong. Okay. So, as you can see, this is today's, I am recording this video on 13th of August. This is today's price action. The stock has crashed 8.21% in a single day. That's why I said this was a disaster. The yellow line is my buy price and the red line is my stop loss. I will explain to you how I came up with this stop loss. Okay. First, let's find out where did I buy the stock. So I bought it on 12th of August, that is yesterday. Okay. Before that, this is what I saw before making my purchase. So why did I buy the stock? First, let us look at the moving averages. So the 50-day moving average, which is the blue line, is above the 150-day moving average, which is the green line, which is above the 200-day moving average, simple moving average, which is the red line. So you have the blue, green, red combination, which is what I look for. And there, all three of the moving averages are sloping up. The price is above the moving average. This is a nice stage two uptrending stock. If you are wondering why I keep saying stage two stock, then I encourage you to read Mark Minervini's book, Trade Like a Stock Market Wizard or Think and Trade Like a Champion. He has written two books. In those two books, he clearly explains what a stage two stock is. So basically, a stage two stock is where the 50-day moving average is above the 150-day and the 150-day is above the 200-day. This is the fundamental definition. There are some other criterias as well, but this is the fundamental definition. This is what indicates that the stock is in a defined uptrend, because these are long moving averages on the daily time frame chart. It takes time for that blue, green, red combination to come up. The stock has to show positive price action for a significant period of time for these moving averages to come together in this blue, green, red combination. So it takes time for a stock to get into stage two. But once it gets into stage two, there are good opportunities to buy as the stock comes out of the base. So that is reason number one, stage two stock. Reason number two, you look at this base here. Let me draw that base for you. So this is 0.1 in the base, which is the highest point in the base. After 0.1, what is the lowest point in the base? See, this is the lowest point in the base. So I join that. After 0.2, what's the highest point in the base? So this is the highest point in the base. So I join that. After 0.3, what's the lowest point in the base? This is the lowest point in the base. So that becomes my 0.4. Now again, after 0.4, what's the highest point in the base? The high of this green candle. Okay, that's the highest point in the base. Between the red and the green candle is higher than the high of the red candle. So that's point number 5. After 0.5, what's the lowest point in the base? The low of this red candle. So this is how it looks like. So there are total 6 points in the base: 0.1, 0.2, 0.3, 0.4, 0.5, 0.6. 6 points means 3 corrections. I am looking for a minimum 4 points and 2 corrections. So this is one correction, this is second correction, and this is the third correction. Okay. And every correction becomes smaller than the previous correction, which is what we are looking for. We are looking for contraction in price and we are looking for contraction in volume. So this is contraction in price. And as you can see, after a high volume rally, you get a low volume consolidation. So minimum 4 points in the base, minimum 2 contractions in the base, and the moving average. What's the third criteria? I want minimum 10 candles in the base. So this is point one. So I start counting from the next candle. So this is candle one, candle two, candle three, candle four, and so on. As you can see, there are comfortably more than 10 candles in the base. I would say there are 50 candles in the base. Okay. I need only 10. So basically, that's the criteria. There are three criteria I look for: the moving averages, the blue, green, red, the 10 candles after point one candle, and 4 points in the base, or more than 4 points in the base, which means minimum two corrections in the base. Okay. Why 10 candles? Because I need minimum 2 weeks of consolidation. 1 week has got 5 candles. So 10 candles means 2 weeks. So those are the three criteria I use. Apart from this, if there is a falling window in the base, and if that falling window has not been broken, then I don't consider that as a valid base. I will show you the example of a falling window in some other video. That is not the point here. Let us discuss where did I buy the stock. So my buy point is point number 5, because this correction has been completed. So I keep my yellow line at the high of this green candle, which is 923.25. Okay, that's my buy point. And I decide that this time, instead of keeping an 8% stop loss, I will limit my risk, because I see that the lot of stocks were going up and coming down. Okay. So there are a lot of fake outs in the market. There is a lot of news coming out in the market, big bang news coming out every day. So the market has become very volatile. So I decided, let me limit my risk. Instead of keeping an 8% stop loss, why not keep my stop loss at point number 6, which is the low of this red candle, which is 882.75. So now if we look at risk, what's my risk in this? My risk is 4.34% risk, which is almost half of the normal 8% risk that I take. So immediately while getting into the stock itself, I have reduced my risk by half. Okay. What's my position size here? I keep a 2.5% position size. It's a decent position size. It's a small position size. I am not taking too much risk. I am not putting too much of my portfolio into a single stock, and I'm also limiting my losses. There are two ways to limit your risk. Number one, reduce your position size. Number two, move the stop loss up. I prefer the first method, which is reducing the position size. I don't tend to move my stop loss up, because I want to give whatever shares I buy, I want to give that stock enough room to fluctuate around the yellow line. Okay, after it breaks out of the yellow line, I want to give it enough room to fluctuate before it starts the next leg of its normal rally, which is the next rally of that stage two. Remember, this is a stage two stock. It's a powerful stage two stock. After completion of the base, it might start to move up. So hope you understand why I've kept the buy point here, and the red line here. Red line is my stop loss. So around 4.34% stop loss. Now look what happens next. I put the order. It's a buy stop order if you are in the US. It's called as a buy stop order. If you are in India, it is called as a GTT buy order. GTT means good till triggered. So it's basically an automatic order. When the price hits the yellow line, I automatically get the shares. So 2.5% of my portfolio, that much amount of money gets deducted from my account, and I get that many number of shares. So it's all automatic. I don't need to be in front of the screen to buy the stock. Okay, I like that kind of a stress-free trading system. We are not doing intraday here. This is simple, simple swing trading techniques like 15-20% gain. I would be much more inclined to sell the stock. Okay, if everything goes well. Coming back to the discussion, let's see what happens next. So that's a fake out. Okay, it's a low volume fake out. Now, what do I mean by fake out? Fake out means the price opens here, starts to go up, okay, touches my yellow line, triggers my order, fills my order. So I get the shares, continues to go up. But as you can see, there is no volume action, okay? There is no price action. So since there is no price action, or since the price has closed below the yellow line, I have to sell 50% because I did not get what I was expecting from the stock. See, if I give you an example of a railway station, if you expect the train to come at 9 o'clock in the morning at the railway station, and if you are there, if the train doesn't come, okay, if it doesn't come for 5 minutes, fine, 10 minutes, fine, 15 minutes, still okay. But half an hour, you will start looking for some other options, right? So you are not getting what you are expecting. Okay. Similarly, in trading, I was expecting the price to close above the yellow line, which I did not get on that day. So I decided that I will sell half. Okay. That was my decision to sell half. I had not implemented the decision. I decided that I will sell half. Moreover, during the day itself, I did not see much volume coming in. Okay. So I decided that since there is no price action, it deserves to sell. The stock needs to be sold half. Since there is no volume action, another half needs to be sold to control my risk. Okay. Price is not supporting me. Volume is not supporting me. Why should I hold on to the stock? Okay. It makes sense to reduce the position size. As I said earlier, uh, my style of reducing risk is by reducing the position size itself rather than dancing around or playing around with the stop loss. Because if I play around with the stop loss, the stock might come down, hit my stop loss, and then double from there. Well, I don't want that to happen. I want to give the I want to give the remaining shares of the stock some room to fluctuate. Okay. Now, in this case, something unique happened. On that day, I had four other stocks in my portfolio and they were doing well. Almost all four stocks had a relative strength of between 91 and 95. So all four stocks were doing well. If I remember the names, they were Oil India, Servotech, EMS, and Zomato. Okay, Zomato, I have made a separate video. So all four stocks were up. And this stock, I think by 11 o'clock or 12 o'clock in the middle of the day, in the middle of the market section, it was somewhere near here. So 0.79 or something. Somewhere it was here. Okay. And it was a green candle by that time. But even though it was a green candle, I knew that it is going to be a fake out day because a true breakout stock, it just explodes in price action. It just starts to go away within 15-20 minutes. Within the first 1 hour, this volume is way above this 50-day simple moving average of volume, which I did not see in this stock. So I had almost, I knew that this is not going to be the uh, breakout day, which I expect. In most probability, it is going to be a fake out day. Now, sometimes what happens is sometimes in the afternoon, like 2:30 in the afternoon, just 1 hour before the market closing, the stock just skyrockets. Something like this or something like this kind of volume comes. Now, that is something which we as professional traders cannot predict. And we are not in the business of prediction. We are in the business of controlling our risk. So somewhere around 11:30, I looked at all my positions. So there were 5 positions, including this stock. I said to myself, okay, if I sell everything now, because all the others were making money, I said to myself that if I sell all my shares now, including this, what will be my realized gain? Okay. And by how much my existing realized gain would go up. So existing realized gain means I'm measuring my realized gain over a certain sample, or maybe from the start of the month, or maybe from the start of the previous month. Whatever time period I'm using for my realized gain, I take that number and I compare that number to the uh, realized gain if I sell all my shares in the portfolio at that particular time. Okay, because I want to sell in strength. So I realized, in a nutshell, I will tell you that I realized that at this point in time, when the stock is somewhere here, if I sell all my shares, if I liquidate my entire portfolio, my existing realized gain would jump by 50%. Okay. So if I have X as my realized gain currently without selling anything, it will become X plus 50% of X. Okay. So, and that's a good deal. I said, okay, if I have to sell 5 stocks to create a 50% jump in my realized gain, I think that's a good deal. Now, what's the risk in doing that? Well, if I sell, there might be out of those 5, there might be some stocks where I sell too early. right? For example, EMS or Zomato, maybe they will double from the price where I have sold. Okay. But I don't know what is going to happen in the future. What I see at this point in time is that if I sell all my shares in the portfolio, okay, then my realized gain, existing realized gain jumps by 50%. So that is a reason I decided that I will sell my stock where it was around 0.79%. So that is the reason I sold this stock. Otherwise, in a normal scenario where I don't sell anything, I would have definitely sold 75% of the shares just 5 minutes before the close of the day, because 50% because there is no price action, and another 50%, which is 50% of the remaining 50% for no volume action. So I would have definitely sold 75% of my shares just 5 minutes before the closing of the day. That's my idea of reducing risk without moving the stop loss. So by the end of this day, I would have had 25% of the original shares that I bought, but that did not happen. I just liquidated my portfolio and created a 50% jump in my realized gain. So sometimes as a trader, sometimes as a risk manager, we have to do some certain things which are out of the box, which doesn't fit into our rule. Selling this stock did not fit into my rules. Okay. But I violated my own rule because I could see my realized gain jumping by 50%. Okay. So that's allowed. I give myself that flexibility as a risk manager to do that. Selling on strength always gives me the chance to finance my future trades. So I hope you understood why I sold. I have tried to give a proper reason or justification as to why I sold. I know you will have to imagine what I am saying, but practically, when you are trading, position sizing or risk management is not just about what you see on the chart. It is also about what other positions you have in your portfolio and how they are doing collectively as a part of the portfolio, and how it is affecting your existing realized gain. Are your current holdings eating into your realized gain, or are they adding to your realized gain? If they are adding to your realized gain, it makes sense to reduce your position size to uh, keep compounding your realized gains. Okay. So this video is less about chart analysis and more about risk management and how I think about my portfolio exposure, how I think about risk management. When do I violate my own rules? Sometimes I violate my own rules just for the sake of risk management. Okay. And how well that has played out. Look what happened. Today it crashed 8.21%. So if I had not sold all my shares here, then I would have definitely, on the remaining 25% of the shares which I would have held, on those shares, I would have lost total 4%, 4.34%, whatever was the stop loss. I would not have booked 8.21, of course, because that much risk management, that's the basics of risk management. Okay. I would have not done that. But that is how I managed to escape this. That's why I told you that this stock was a disaster, but I had a narrow escape from this stock. Anyways, it would not have affected my portfolio too much because I would have definitely sold 75% of my position size on 12th of August. And on 13th, I would have booked the remaining loss, which is not much, like 25% of 4%, which is like 1%. Okay. So 1% loss on a position size of 2.5% is hardly anything as a percentage of total portfolio. That mathematics we will discuss in some other video. But I hope uh, that you understood, you enjoyed watching this video. Uh, it's intense. It is risk management. Trading is not easy. Let me tell you, a lot of things we have to consider. We can't look at individual position and individual charts. We have to look at the entire portfolio. Individual position size is as important as total portfolio exposure, which is as important as worst case scenario and your realized gains. I always continue to compare my realized gains with my worst case scenario, and I always try to ensure that my realized gains are always more than my worst case scenario. A worst case scenario is where if all your positions hit your stop loss, how much money will you lose? That's your worst case scenario. By the way, that's a theoretical worst case scenario. Practically anything could happen. A stock could open below, a stock could break down below your stop loss with a falling window. That's a disaster. Okay. And those kinds of things happen in the market. It has not happened to me. It was about to happen to me in Sudarshan Chemicals. I have made that video. You can check that video, but I had a narrow escape in that as well. Instead of 8% stop loss, I ended up booking 2.58% stop loss. Please watch that video as well. So every time I book a loss, I become very happy because I have these losses to share with you, because I notice not many people like to talk about their losses, whereas losses are an integral part of trading. Okay, there is no system where you cannot have a loss. Okay, 50% of my trades, if you watch all my videos on my channel, 50% of my trades are not making money, right? That's what trading is all about: risk management, position sizing. Okay, so had a narrow escape here. And if you notice, you see price tightening here to here, from 3 to 4 and 5 to 6. This was the price tightening that I observed. Let me, if you look at this bar chart, just a second. I don't know why it got hanged. Yeah. If you look at this bar chart, okay, see, price is tightening and tightening further. See, here you see consolidation and tightening. That is why I decided that it makes sense to make a purchase here. Why did I not buy on this tightening? Because this is in the red zone. I don't want to buy in the red zone. I want to buy in the blue zone or in the green zone. Here I got a green zone. Here I got the buy point at the green zone, which is fantastic. And the icing on the cake was I got 6 points in the base. Okay. Normally, if the buy point is in the blue zone, I demand that I get at least 6 points in the base. But if the buy point is in green zone, I'm okay with 4 points because the price has already made a good advance and I can play the stock for a quick move. Okay. Well, in spite of that 8% drop, the stock still remains a stage two stock. Okay. So if this continues going forward and completes the base and creates a new price action here, well, then I might again be interested in the stocks. Let's see what happens. But as of now, I don't hold this position. I have sold all my shares. And I hope I was able to explain properly why was the reason I sold my shares. Why is it that I violated my own selling rule? Sometimes we have to do that, okay, just for the sake of risk management. Thank you so much.